Hello, this is Jordan, and this is your precious metals video market update. Today is Thursday, May 28th, 2015. And in this update, I'm going to focus solely on gold. This first chart shows all of the bear markets in gold, but it excludes two bear markets, which one was the extreme in terms of time, that was 1987 to 1993. And then one is the extreme in price, and that was the crash from 1980 to 1982. One thing we should note about those crashes is that they tend to happen quickly. You see those types of bear markets last no more than 2.5 years or so. And in terms of this chart, in the current bear market, that crash, I believe, went to below 800 or 700. I think it was below 700. Anyway, in this chart, we're using weekly data. The current bear is in black, and you can see it's extremely similar to the bear in 1996 to 1999. And I think this analog chart gives us a good frame of reference for what we can expect as this bear looks like it's going to continue, but still, to me, looks like it's in its final stages. And we're hearing some predictions of $700 or $800, and I just don't see any basis for that in any of my work. And this chart gives you one example where you can see maybe this bear declines to 1,000 or thereabouts. That makes a lot of sense to me, and I'll get more into that. But anyway, another note on the crashes. The reason why they tend to happen sooner and those bear markets are shorter is because the people are already wiped out. When you get into a bear market that lasts over 3 years like this one, and it looks like it's going to last 4 years, most people are already wiped out. So sure, you can have severe moves at the end, but those crash type moves, it's just very difficult for them to happen when the bear market is much longer. Anyway, let's get to the next slide. This is a weekly line chart where we have gold with its 80-week moving average. And then at the bottom, we have GVZ, which is gold's volatility index. Again, talking about the support, we talked about 1,000 on the last slide. The next clear major support is 1,000, and you could say 1,000 to 1,050 perhaps. And the problem with gold over the last couple of years, there just wasn't any real strong support other than 1,550 and then down to 1,000. So gold has worked its way lower over the last 2 years, but it's been a grind lower. It's been very, very slow. It's been very difficult for bears and bulls. But we can see that triangle and also factor in that gold, it has this base going for 7 or 8 months or whatever it's been. And so that's kind of setting up, if gold breaks below that, it's setting up a strong potential for a strong breakdown. And again, you can see the triangle there, which is also in play. Break below that, that's another reason why you'd expect a sharper move down if gold breaks below 1140, 1150. Now, in addition to that, in this chart with the volatility, I highlight the last 2 times where volatility bottomed and then right before it started to move higher aggressively. And you can see those times what happened. Gold started going down and then it accelerated lower as volatility spiked. So we're coming into a situation where volatility is still going down, but perhaps in the next month or two you could see volatility bottom and then start to turn around. So that's another reason to think that if gold breaks below 1140, 1150 on a weekly basis, you get some increased selling and then volatility spikes up, and that breakdown then accelerates to the low 1100s or whatever. 1080 is the 50% retracement of the entire bull market. So that's also a target to keep in mind. But the real strong support is going to be 1,000 to 1050. And here, another reason that we have to be bearish in the near term is gold COT. This is a very long-term chart. Again, it's a weekly line chart of gold. At the bottom, we plot gold's COT, which is the net position, the net speculative position as a percentage of open interest. And the last reading was at 31%, which is, you go back the last 4 or 5 years, that's kind of in between where the range has been. And considering that we're in a bear market, that 31% is very high. I mean, just go back and look at where the lows were in 2013, and I think very early 2014. The lows were at 6% and then 7%. So where we are right now, I mean, that's a real problem for gold bugs and people who are bullish on gold, because there's just too many speculators left in the market. We need to see that 31% much lower. And if gold does trend lower and break below that key 1140, 1150 weekly level, obviously you're going to see a lot more speculators give up, and that will drive the COT lower. What we really want to see to get bullish is gold obviously breaking down, but gold gets really close to that 1,000 to 1050 level, and then you see the COT perhaps even below 6% and close to 0%. I mean, if it's below 6%, the net position would then be at a 13-year low. So it's kind of that combination of really extreme bearish sentiment in a market that is approaching very, very strong support, which would be 1,000 to 1050. So keep those things in mind. Unfortunately, this is still a bearish picture, but it looks like we might have a chance where we could see the end of this bear market start to play out in the weeks and months ahead. You can follow more of my work at thedailygold.com. We have a free newsletter, and with any questions or comments, you can email me, Jordan at thedailygold.com. Thank you all for listening or watching.